Hi guys, welcome back to Diversified, and today I'll be sharing with you something special. I manage more than 6 million worth of investment assets, and today's topic is about how you can manage investments a bit better. I'll be giving you some secrets, 10 of them to be exact. So if this interests you, continue watching on. The first principle is to choose diversification and avoid sector bets. For example, if you're interested in Indonesia, you feel that they have a lot of economic reforms and you feel the stock market has a lot of potential to go upwards, the method to get exposure to Indonesia is through ASEAN funds, for example, because a diversified approach makes sure that your returns are smoother and yet you have exposure to that preferred sector. I'll put a quick chart over here to show you. This is an example. If you have invested in a diversified ASEAN fund versus an Indonesian fund, returns are roughly the same, but the track is so much smoother when it comes to an ASEAN fund. You get a lot less volatility, and that makes all the difference in the investment journey. In certain circumstances and in certain periods, the performance is even better when you are in a diversified approach. So that is the first principle to take note. The second principle is to always have bonds in your portfolio, and not just that, to have a diversified approach when it comes to bonds. Some with a longer duration and some with a shorter duration. As you can quickly see in this chart over here, duration is a very important factor that drives bond performance, not just the risk asset, whether it's emerging markets or high quality bonds. The duration is increasingly becoming an important part in terms of the returns itself. So when you are diversified, if interest rate news moves positively or negatively, you have some exposure to it, and that's the second key principle to share with you. The third key principle is to always avoid sexy ideas. Back in 2008, it was commodities, how you can invest in agricultural funds and stuff, and not long after that, there was a bust in agriculture. And today, what you see sexy is artificial intelligence. You see disruptive word being thrown around and funds being created specifically for that. How about cloud computing? There's also a cloud computing ETF. So avoid sexy funds, sexy ideas, because that is going to be detrimental to performance in the long run. The fourth key principle is to buy into boring ideas or things that have been overlooked. So right now, I'll put a quick chart over here on the idea. This is emerging markets. So back a couple of years ago, everything was rosy on technology and stuff. Emerging markets was neglected. And that's where value actually is. And in a quick 1 year, they actually did a 40% gain. So when you look for boring ideas, that's where you get untapped potential and potential growth that's above the normal, because that is where most investors are not looking at. The fifth key principle is to stick to Sing dollar, SGD. Currency is a zero-sum game. Today, Australian dollar is down. Today, British pound is down. Today, even renminbi is down. Many can say that there's a lot of potential in these currencies that you can start investing into it. And conversely, today US dollar is on the up, and many people can say that you should invest in US dollar because that is where the trend is. But currency is a zero-sum game, and it makes the investment equation a lot more complicated. So the fifth principle again is to stick to Sing dollar. Stick to Sing dollar funds, stick to Sing dollar investment ideas. I'd like to invite you to smash the subscribe button and get notified whenever we release a financial video for you, and join our community to become more financially savvy. And the sixth principle on how you can manage investments better is to learn to filter out noise. Market news is always bad, and if you learn to filter out noise, you can see opportunities a lot better. And I remember back in 2008, everything was negative, and it was very hard to get invested at a point of time because news always sounded like that. I'll play a clip for you to let you get a sensing of it.
The stock market is now down 21%.
Because we're now down 43%.
The seventh key principle is to expect the worst. Expect to be longer than many people expect. And that is very important because back in this chart over here, as you can see, most people do not have the tolerance, especially towards the tail end of the bear market. And if you keep this principle close to heart, you'll be able to understand that at the tail end of the market, when most people give up, that's the best time to get invested and set your expectations correct, because that's where you're really going to get high rate of return. The eighth principle is to not time the market. I know this has been commonly mentioned, but it's very important to have the right mindset, because if you're trying to time the market, today I'll be 100% into equities, tomorrow I'll be 100% away from my equities, I try to sell out before the bad news comes. That is timing the market, and it is dangerous. And it's like investing is like playing chess. To win in a game of chess, sometimes you have to have losses to your horse, to your bishop, to your knight, and it's the same for investing. If you want to win, if you want to get to financial freedom, then along the way there can be losses that you need to attain in order to get to that success level. So again, investing well requires you to not time the market. The ninth principle is not invest everything in one shot. Just before the market turns rosy, you would like to get everything invested all in so they can participate fully, but that doesn't actually work. That has similarities to the previous point, not timing the market. Not investing everything in one shot is very important, because I'll put a quick chart over here to show you. Its investment journey is up and down. It's not a linear straight line upwards. And in this up and down cycles, if you invest everything in one shot, you have a lot of emotion attached to it and you tend to make mistakes. Rather, the better method is to go in bit by bit, get invested gradually, and especially at levels where you are comfortable at. And that's a key principle in investing well. The 10 key principles is to hold on to your investments well, hold on to your winners, because things when they pull up, they go up very fast. So if they pull up a little bit and start selling out, that's where you miss out on big gains. And I'll pull a quick chart over here to show you. This is a chart that I've shown you in the previous point, whereby emerging markets actually pulled up 40%. And imagine this, if after a 7% gain, you decide to cash out quickly because you're so tired of holding onto it, you will have missed out more than 30% of gains. The better method is to sell bit by bit, to always hold on to investments and look for it long term. If you're new to investing, I would suggest you speak to a qualified financial advisor to get invested properly. And if you have questions, leave them in the comment sections. I'll try my best to help you answer. And again, I'd like to invite you to click on the like button so that more people can see this video on 10 principles to help them invest a bit better. So with that, I'll sign off. Take care and goodbye.